Commodity trading is simply the buying and selling of raw materials. Think of it as the world's oldest and most essential marketplace. We are talking about the fundamental building blocks of our global economy. These are not stocks in a company or bonds from a government. No, these are the physical goods that we grow, extract from the earth, and refine to power our lives. From the coffee in your morning cup to the gasoline that fuels your car, commodities are everywhere. Understanding this market is crucial because their prices affect everyone, from large corporations managing their costs to individual consumers paying for everyday items. It is the bedrock of global commerce. The world of commodities is vast and can be neatly divided into several key categories. First, we have agricultural products, often called soft commodities. This includes everything that is grown, such as wheat, corn, soybeans, sugar, and cotton. Then there are the hard commodities, which are mined or extracted. This group is further split. We have precious metals like gold and silver, which are often seen as safe havens in uncertain times. We also have industrial metals like copper and aluminum, which are vital for construction and manufacturing. Their demand often signals the health of the global economy. Energy resources form another critical pillar of the commodity market. This category includes crude oil, the lifeblood of modern transportation and industry, as well as natural gas, which heats our homes and generates electricity. Coal also falls into this group, though its role is changing in a world increasingly focused on renewable energy. The prices of these energy commodities have a direct and immediate impact on almost every aspect of our daily lives. When oil prices rise, it doesn't just cost more to fill up your car, it costs more to produce and transport nearly every other product you buy. Ultimately, commodity trading matters because it is intrinsically linked to the cycle of production and consumption that drives our world. It connects farmers in Brazil growing coffee beans with roasters in Italy and cafes in New York. It links miners in Chile digging for copper with electronics manufacturers in China and home builders in the United States. This intricate web of supply and demand is what makes the commodity market so dynamic and so important. The prices determined in this market ripple outwards, influencing inflation, corporate profits, and the economic well-being of entire nations. It is quite simply business at its most fundamental level. Trading these essential goods doesn't happen in a chaotic old-world bazaar. Instead, it is a highly organized and standardized process that takes place on specialized exchanges. Think of the Chicago Mercantile Exchange, or CME, or the Multi-Commodity Exchange, MCX, in India. These exchanges don't deal with the physical barrels of oil or bushels of wheat directly. Instead, they facilitate trading through standardized contracts. The most common types are futures and options contracts. A futures contract is a legally binding agreement to buy or sell a specific commodity at a predetermined price on a future date. This creates predictability in a volatile world. The reasons people trade commodities are just as important as how they trade them. Broadly, participants fall into two camps: hedgers and speculators. Hedgers are the producers and consumers of the actual commodities. A farmer, for instance, might sell a futures contract for their wheat crop to lock in a price and protect themselves from a potential price drop before harvest. Similarly, an airline might buy oil futures to secure its fuel costs for the coming year. For hedgers, commodity trading is a risk management tool. It is about creating certainty and protecting their business from wild price swings. On the other side, we have the speculators. These are traders who have no intention of ever taking physical delivery of the commodity. They are not interested in the soybeans themselves. They are interested in the price of the soybeans. Speculators aim to profit from the price movements in the market. They might buy a futures contract believing the price will rise, or sell one expecting it to fall. While often viewed negatively, speculators play a vital role. They provide the liquidity that makes it easy for hedgers to enter and exit the market, ensuring there is always a buyer for every seller. In India, this complex marketplace is not a free-for-all. It is carefully regulated to ensure fairness and transparency. The Securities and Exchange Board of India, or SEBI, is the chief watchdog. SEBI sets the rules for the exchanges, brokers, and all market participants. Its job is to protect investors, prevent market manipulation, and ensure the orderly functioning of the derivatives market. This regulatory oversight is crucial for building trust and confidence, encouraging more participants to use these markets for both hedging and investment, which in turn helps in better price discovery for the entire nation. Commodity markets do not exist in a vacuum. They are incredibly sensitive to events happening on the global stage. Geopolitical tensions, such as wars, trade disputes, and sanctions, can send shockwaves through these markets, causing prices to swing dramatically. When global stability is threatened, the intricate supply chains that deliver raw materials around the world are put at risk. A conflict in a major oil-producing region or a trade war between two economic superpowers can instantly change the delicate balance between supply and demand, leading to significant price volatility that affects everyone. A stark and recent example is the Russia-Ukraine conflict. Both countries are major global suppliers of key commodities. Russia is a giant in energy, providing a significant portion of Europe's natural gas and oil. Both nations are also critical breadbaskets, exporting enormous quantities of wheat, corn, and sunflower oil. When the conflict began, it triggered immediate and severe disruptions. Sanctions imposed on Russia and physical blockades in the Black Sea choked off supplies. As a result, the prices of natural gas, crude oil, and wheat skyrocketed globally, fueling inflation and raising concerns about food security in many parts of the world. Similarly, the US-China trade war had a profound impact, though it operated through different mechanisms. This was a conflict fought with tariffs, not tanks. When the United States imposed tariffs on Chinese goods and China retaliated with tariffs on American products, it directly hit agricultural commodities. US soybean farmers, for instance, saw their largest market suddenly shrink as China turned to other suppliers like Brazil. This caused soybean prices in the US to fall while creating new trade flows elsewhere. It demonstrates how economic policy and diplomatic friction can redraw the map of global commodity trade almost overnight. During such times of uncertainty, we often see a flight to safety among investors. When geopolitical risks are high, traders and investors tend to move their money out of what they perceive as risky assets, like stocks, and into safe haven assets. Gold is the classic example. It is a physical asset with a long history as a store of value. During crises, the demand for gold often increases, pushing its price up. This behavior is not driven by the industrial use of gold, but by its role as a financial anchor in a storm, a safe port for capital, until the geopolitical seas calm down. The impact of these global events is felt differently in various regions, and India is no exception. As a major importer of commodities, especially crude oil and edible oils, India is highly vulnerable to global price shocks. When the price of crude oil surges due to a conflict in the Middle East or sanctions on Russia, India's import bill swells. This directly affects the country's trade balance and puts downward pressure on the Indian rupee. A weaker rupee, in turn, makes all imports more expensive, creating a vicious cycle that can drive domestic inflation higher, impacting household budgets across the nation. Conversely, India also benefits from certain global shifts. For instance, during the US-China trade war, India saw an opportunity to increase its exports of certain goods to both countries as they sought alternative partners. The Indian government and businesses are constantly navigating these complex dynamics, looking for ways to mitigate risks and capitalize on new opportunities. The reaction of local markets is also key. A global price surge in a commodity that India also produces, like wheat or sugar, can benefit Indian farmers by fetching them higher prices, even if it means higher costs for consumers. For individual investors in India, commodities offer distinct benefits. One of the most important is diversification. Commodity prices often move independently of stock and bond markets. Including commodities in an investment portfolio can therefore help reduce overall risk. If the stock market is falling due to an economic slowdown, commodity prices might be rising due to supply constraints, helping to balance out the portfolio. Another major benefit is protection against inflation. Since commodity prices are a major component of inflation, holding commodities can help preserve the purchasing power of your money when the general cost of living is rising. In conclusion, The world of commodity trading is a fascinating intersection of economics, politics, and human behavior. It is a market that connects a farmer in a remote village to a high-frequency trader in a financial capital. It is profoundly shaped by global events, from military conflicts to diplomatic handshakes, and its movements ripple back to affect economies and individuals worldwide. For a country like India, understanding and navigating this complex global market is not just an option, it is an economic necessity. The flow of commodities is, and always will be, the true story of global business.